Hello everyone, and welcome to today's presentation. I'm excited to introduce you to an advanced trading methodology that centers on institutional market logic. Today, we'll explore a precise framework for entries based on market imbalances. Our focus will be on an advanced smart money concept framework designed specifically for experienced retail and professional discretionary traders seeking greater accuracy. We'll walk through the BOS plus FVG strategy, your smart money entry model, step by step. So let's dive in and see how this approach can elevate your trading game. Without a confirmed BOS, traders lack crucial validation for their directional bias, preventing premature or uncertain entries. When we talk about break of structure, or BOS, we're referring to those key moments when the price decisively moves beyond a previous high in an uptrend or drops below a previous low in a downtrend. This move acts as a strong signal, confirming whether the trend is likely to continue or reverse. BOS highlights areas where significant institutional order flow has entered the market, indicating a strong directional intent. It's like a confirmation that big players are stepping in, and that adds a lot of weight to the move. This makes BOS a powerful filter. It helps us distinguish genuine, sustained moves from market noise or false breakouts, which can often lead traders astray. Understanding BOS is essential because it provides that critical confirmation we need before committing to a trade. It gives us clarity, whether we're entering in the direction of the trend or watching for a potential reversal. So, in essence, BOS isn't just a technical point. It's a marker of institutional intent and a key element for trend confirmation. Smart money players are actively taking advantage of these imbalances in the market. They understand that the price often revisits these areas to complete order delivery and reach fair value. Markets are naturally designed to seek equilibrium, meaning they tend to move back to these fair value gap zones to fill or rebalance any inefficiencies. That's why these zones become high-probability areas for entries. A fair value gap, or FVG, is essentially an inefficiency or imbalance in how prices are delivered. These gaps are usually created by strong, impulsive moves where buy or sell orders are heavily skewed in one direction, leaving a sort of empty void in liquidity. Understanding these FVGs is crucial because they highlight where the market might return to rebalance itself. Recognizing these imbalances helps us anticipate potential price movements, making FVGs valuable tools in our trading strategies. This confluence highlights an important concept in trading. While market structure, as you know, provides us with the general direction or trend, the FVG, or fair value gap, helps us identify the exact entry point where institutions are likely to re-engage the market. It's like having a roadmap with a pinpointed landing zone. The highest probability entries often occur right before a break of structure, or BOS, when there's a liquidity sweep. This sweep confirms institutional participation and sets the stage for a retest of the FVG. Essentially, we're looking for those moments when liquidity is gathered and then targeted, giving us a clearer signal that the institutions are active. Now, when the FVG aligns with the confirmed trend bias, our chances of a successful retest and continuation increase significantly. This is what we call trend alignment, and it makes our setups much more reliable. Remember, a fair value gap usually forms during a strong, aggressive move that creates the BOS. This indicates a moment of strong institutional conviction. It's like witnessing the market's stamp of approval for a directional move. And finally, the break of structure, or BOS, gives us that clear directional bias. When we see a BOS alongside an FVG, it confirms the trend and signals a high-probability entry point. This confluence of BOS and FVG is a powerful tool in our trading toolkit, helping us pinpoint optimal entries with greater confidence. True precision in trading really comes from careful observation and sticking to a well-defined trading plan. When you exercise patience, you increase your chances of identifying higher probability setups, which is key to consistent success. Now, setting your stop loss strategically is crucial. You want to place it beyond the fair value gap or beyond the relevant market structure, like the break of structure level. This helps protect your position while giving it room to breathe. Next, when it's time to execute your entry, wait until the price touches or shows rejection from the FVG. Sometimes, it's best to do this on a lower time frame for added precision, so you can get a clearer entry point. Once you see that rejection, be patient. Allow the price to retrace back into the marked FVG. That's your potential entry zone. Patience here can really pay off. Identify the FVG within the impulsive candle that created the break of structure. This FVG represents a market inefficiency, a gap where the price moved quickly and created imbalance. Then look for a clear impulsive break of the most recent significant high or low, aligned with your higher timeframe bias. This confirms the break of structure and signals a potential move in your preferred direction. Watch for price sweeping previous highs or lows. This indicates stops are being triggered and institutional orders might be entering the market, which can lead to strong moves. Finally, always determine the overall market direction on higher timeframes like the daily or 4-hour charts. This helps you align your trades with the dominant trend, increasing your chances of success. By following this step-by-step entry model, you build a disciplined approach that combines patience, precision, and alignment with the larger market context. When it comes to risk and reward, I always aim for a minimum RR ratio of 1 to 2. But ideally, I'm targeting 1 to 3 or higher. This helps ensure that over the long run, my trades stay profitable and that I can manage my trades effectively. Now, for take profit levels, I like to look at higher timeframe points of interest, or POIs, because these tend to be areas where we see stronger market reactions. These levels are more reliable for setting targets because they align with larger market structures. Speaking of larger structures, the next HTF POI is often a good place to aim for, especially if it coincides with larger liquidity pools. These pools are where institutional orders are likely resting, and capturing that liquidity can lead to substantial profit. When identifying these liquidity pools, I focus on obvious previous swing highs or lows. These are common turning points, areas where price has historically reacted strongly, making them ideal targets for profit-taking. Alternatively, for stop-loss placement, I prefer to position it clearly beyond the broken structure, either above for shorts or below for longs. Specifically, I look at the level that was broken by the break of structure, or BOS, because this confirms the new trend direction. Another key point is beyond the fair value gap, or FVG. I place my stop-loss just beyond the extreme of this zone, allowing for minor wicks into the gap without getting stopped out prematurely. In summary, these strategies, balancing risk and reward, using HTF POIs, liquidity pools, and carefully placing stop losses, are all about managing risk effectively while maximizing profit potential. They're essential parts of a disciplined trading approach that helps me stay aligned with the overall market structure. Always remember, successful trading is all about trading the imbalance and diligently following the footprint of smart money for high-probability setups. This means paying close attention to where the big players are positioning themselves, which gives us clues about where the market is likely headed. It's crucial to set appropriate stop-loss and take profit levels right from the start. Doing this helps us maintain a favorable risk-reward ratio, which is the foundation of sustainable trading. Never forget, risk management is key. Next, we only execute a trade when the price returns to a specific area, the fair value gap, or FVG, and shows a confirmed reaction. This confirms that the market is responding as expected before we commit. When identifying the entry, precisely mark the FVG within the break of structure, or BOS, candle. This is our re-entry zone, the spot where the market is giving us a clear sign that the move is likely to continue in our favor. Make sure a clean FVG is marked, meaning it's well-defined and free of clutter. This clarity indicates a strong impulsive move, signaling robust directional intent from the market. Also, verify that a confirmed BOS has occurred. This involves observing a strong break in structure, which often signifies a shift in market momentum and the start of a new trend. Before the BOS, check whether the price has swept a key liquidity zone. This liquidity sweep confirms that institutional players have moved the market, adding validity to the structure break. Lastly, always confirm that the trade's direction aligns with the dominant trend on higher timeframes. Trading in harmony with the larger trend increases our chances of success, making the entire setup more reliable. So, in summary, this BOS plus FVG trading checklist helps us stay disciplined, focused, and aligned with the market's true intentions, ultimately improving our trading consistency and confidence.